Markets are about to reopen after a weekend that didn't just move headlines, it moved the rules. Multiple outlets are reporting that Iran's supreme leader Ayatollah Ali Khamenei is dead following U.S.-Israeli strikes, with Iranian state media confirmation cited in major reporting. And whether someone likes that news or hates it, the market has one job Monday: reprice reality. Not politely, not gradually, violently. Because when a world-changing event happens while primary markets are closed, price discovery doesn't continue, it pauses, pressure builds, and when the lid comes off, you don't get a normal open. You get a gap, you get whiplash, you get forced hedging, you get spreads widening so fast it feels like the screen is lying. Economic Times frames Monday as the moment gold and silver react to escalating Middle East war risk, with analysts pointing to a likely volatile open and a gap-up type move in bullion being plausible under this kind of shock. And here's what everyone gets wrong about gap-up. They treat it like a prophecy. It's not. A gap is a mechanical event. It happens when there aren't enough offers near the prior, close to satisfy sudden demand. So price jumps to the next area where real liquidity exists. That's not magic. That's an auction. Now zoom out, because this isn't a gold and silver story. This is a world story, a global plumbing story. The Guardian reports oil markets bracing for a surge after Iran's response and disruption risks tied to the Strait of Hormuz, a key choke point, with shipping impacts, insurance spikes, and Gulf market stress all being discussed. And I need you to understand why that matters to metals. Oil is the bridge between war headlines and inflation. Inflation is the bridge between fear and policy. Policy is the bridge between currencies and confidence. Confidence is the bridge between paper and hard assets. So when oil jumps, the war premium doesn't stay trapped in crude. It leaks into everything. That's how you get a Monday that feels like a reset. Now, silver specifically. Silver is not gold's little cousin. Silver is a volatility instrument dressed up as a metal. When fear hits, silver can overreact because it's thinner, it's more speculative, and it's got industrial exposure that makes traders flip narratives fast. Inflation hedge 1 minute, growth scare the next. That's why $100 becomes the obsession. Not because it's guaranteed, because it's the psychological magnet every trader sees from space. Economic Times points to exactly this kind of soar tomorrow framing, the expectation of a sharp reaction at the open. But it also includes the reality that volatility cuts both ways, and profit-taking can follow the initial spike if the tape starts whispering de-escalation. That's the honest version. Here's the engaged version you want for retention. Monday morning is not about being right on a number. It's about surviving the first hour while the world decides what it just became. And the reason the first hour matters is because of who is forced to act. Hedgers, dealers, funds, leveraged positions, options books. They don't think first. They execute first. If volatility expands, dealers hedge gamma. If oil spikes, macro desks reprice inflation probability. If risk assets wobble, risk parity and systematic flows rebalance. If margin requirements change, weak hands get tapped out. That's the machine. Now put the machine against a shock headline like this. You don't get a move, you get a cascade. And here's where the world part becomes lethal for markets. The Strait of Hormuz is one of the biggest energy choke points on Earth. The Guardian notes disruption risk and the knock-on effects for shipping and insurance. Insurance reprices first. Shipping reprices second. Energy reprices immediately. Food costs follow. Emerging market FX feels it. Central banks feel it last. But when they do, the reaction can be blunt and ugly. This is why metals catch a bid. Not because metals are cute, because metals are a lifeboat when policy feels trapped. Now, I'm going to give you the exact two realities structure your training style leans on, the contrast montage your audience loves. Reality 1, paper markets. Paper markets can gap. Paper markets can whipsaw. Paper markets can get margin called. Paper markets can be liquidated with a button. Reality 2, the physical world. The physical world has roots, it has choke points, it has insurance, it has delivery delays, it has premiums that don't show up on a 1-minute candlestick. When war risk hits, those two realities separate. Not forever, but enough to create opportunity and pain at the same time. And if you want the $5 trillion war premium line to feel real, you don't claim it as a fact. You frame it as a concept. The war premium is the price of uncertainty embedded across multiple markets at once. Equities, credit, FX, oil, shipping, insurance, and volatility, all repriced in a compressed time window. You're not saying the premium is exactly 5T. You're saying the repricing can be enormous when you add the world together. That keeps it strong without making it fake. Now, to keep the script grounded, let's anchor the world signal set. Here's what markets will watch at the reopen. Oil reaction spike and hold or spike and fade. Dollar reaction safe haven bid or confidence shock. Volatility. Does VIX-type behavior explode or stabilize? Risk assets. Do futures break or absorb? Metals. Does gold lead and silver chase, or does silver front run with a blow-off? And to keep this engaged like your best competitor scripts, you repeat the key line. The open is not the verdict. The open is the first confession. Now we go deeper. World deep, because your ask is more world. When a regional war threat expands, there are three global transmission channels: energy, trade routes, capital flows, energy, the obvious one. Trade routes, shipping lanes, port closures, insurance premiums, airline disruptions. Capital flows, risk-off rotation, EM outflows, safe haven demand, tighter financial conditions. This is where metals come in. They sit at the intersection of fear plus inflation plus currency confidence. Now, the most dangerous mistake your viewers make, and you can call it out hard, is thinking safe haven means straight up. In real shocks, sometimes the first move is up and then the second move is down because people sell what they can to cover what they must. That means gold can spike and then dip, silver can spike and then flush harder. Then if the situation stays unresolved, the bids return. That's not bearish. That's the machine. So here's the Monday map in your voice. If oil gaps higher and stays bid, metals have fuel. If oil gaps higher and fades, metals can whipsaw. If equities gap down hard, metals can still whipsaw because forced selling hits everything. If equities hold up, metals can trend cleaner because fear finds a single outlet. Now, let's integrate the geopolitical uncertainty premium without becoming a war channel. The WSJ Live page suggests a transitional period in Iran, more officials hit, and instability risk. That matters because regime uncertainty is not a one-day headline. It's a multi-week risk variable, and multi-week risk variables are exactly what keeps a premium alive. Now, silver. Your audience wants the number, but you don't give it like a fortune teller. You give it like a trap setter. Silver at near $100 is the magnet zone traders will target if momentum stays hot. But $100 is also where profit taking can hit hardest because it's the most obvious billboard on earth. So the real question isn't, does it touch $100? The real question is, does it hold above the battlefield after it touches? That's where squeezes begin, or where rug pulls happen. Now we bring in one more world detail your audience will feel in their daily life. Fuel and prices. A major Australian outlet is already warning about a possible petrol price shock if Hormuz disruption becomes real, mapping that directly into inflation risk. That's how you make this global, not with maps, with consequences. Fuel up, food up, transport up, inflation up, rates stay high, risk assets wobble, safe havens bid. That is the chain. Now you hit the big retention pivot. What are banks missing? Banks don't miss the headline. Banks miss the second-order impacts. Banks model data. They don't model chaos well. They can hedge expected volatility. They can't hedge surprise gaps without paying for it. So when the surprise hits, they reprice by widening spreads, pulling liquidity, and forcing the market to jump. That's why Monday opens feel like a trap, because the market has to relocate to a new equilibrium before it can even start trading normally. Now the close of part one is a fork, because forks keep people watching. Two paths. Path A, escalation. Oil stays bid, shipping risk stays real, volatility stays elevated, metals remain supported, silver stays dangerous but bullish biased. Path B, containment. Oil fades, volatility cools, profit-taking hits metals, silver gets a flush, and then the market decides whether the move was fear premium or new regime. And the final line in your exact cadence, nothing is guaranteed except this: Monday will be violent, and the first hour will tell you what the world believes, not what it hopes.